Hey, everybody. Welcome to this episode of Market Mavericks. The three amigos, the three stooges, whatever you want to call us, we are here and ready to give you our insights. So,
I'm not curly. I will not be curly.
okay, fair enough. Scott Melker and Mike McGlone join me today, as always, guys. And let's kick it off. Where do you guys want to start today?
I think FOMC, right?
Yeah, let's talk a little about the FOMC. So the markets seemed to be doing well yesterday, right? And then all of a sudden he said no rate cut in March. The markets tanked yesterday and then they ripped higher today. So
yeah, it was also the last day of the month. So talk about leverage bots, algorithmic trading, getting stopped out, and these one-day options just got to hammer a little bit and you come right back. I mean, that's how markets are nowadays.
Yeah, absolutely. So what do you guys take away from that? Is there anything like, is this the market just saying we don't even care what the Fed says? Like the Fed, I almost feel like the Fed could say, hey, we're not going to raise it all this year. And the markets would be like, nah, we're not going to cut this year. And the markets will just say, no, you're going to cut 6 times still.
Well, kind of what he said.
Yeah.
I mean, he's given no indication that he's really going to cut. He keeps saying, yeah, we're going to cut, but no indication of when. And anyone with a half a brain realizes that he has no reason to do it. I'm not saying he won't. There might be something under the hood, but rationally, if he's going to keep pointing at strong job numbers and inflation coming down and we have to get to 2%, that tune hasn't changed. There's just nothing to do here. Just going to keep paused.
Well, my key takeaway from the macro, trying to take the 30,000-foot view, partly because here, I mean, everyone wants every tick, the little soundbite and stuff, is the old days of rates used to go up on the escalator, down on the elevator has reversed. They went up on the escalator. I'm sorry, in the elevator, and they're going to go down on the escalator, if at all, and it'll be significant lag if things go bad. So the problem right now is for what he's got, they get priced in 160 basis points in a year is, I think, only going to happen if markets make that, meaning going down. And so for now, the Fed has no hurry to be any hurry to cut rates, partly because it's Goldilocks, so I mess with it. And the biggest risk is inflation comes back.
Yeah. So, I think that's important to mention is like, the market's still pricing in as many rate cuts as before he said this. Nothing in the market's regard has changed whatsoever. So I think that that's important to kind of recognize. And, we have the jobs number tomorrow. I'm assuming he got a little sneak peek of that, right? I mean, generally I always look at it like they see that number a couple days, or at least a rough number.
So that is real.
Well,
they revise them down every month for the last 11 months. They tell you whatever number they want. I'm sorry, I'm not trying to put on a tinfoil hat, but they tell you whatever number they need for their narrative. And then when you're not looking, they literally change the number. I'm not making this up.
No, you're 100% right. And the revision isn't small either, right? It's like 20%, 30% revised downward. But, and by the way, I mean, this is something I've been covering in my game plan every morning, is that literally every day you get earnings out. And one of the staples of earnings season has been, we're going to lay 5-10% of our workforce off. I mean, it's every company almost is laying off. So it's coming. And we saw jobless claims jump again this week. They jumped last week. But I agree. I mean, right now this is the number. And then, no one will pay attention or not as many to the revisions down in the coming months.
Well, that was the key thing, I think, part of the reason we're up. And I remember this from the 90s, was non-farm productivity jumped. It was expected to come at 2.5%, came on 3.2%. That's what I'm showing here. And that was a bit of a surprise. But it's also that trend in productivity increasing, inflation declining. I mean, it's Goldilocks. And if you're Chairman Paul, why mess with that? So he's doing a great job, I think, of just navigating it. I thought he raised rates way too much, but they were right. The economy is resilient, but also it happened at the time of the greatest fiscal deficit spending ever, absent a war or recession. And we still have that hangover from the wealth effect from the biggest pump in liquidity ever. And it's a question how much longer that lasts. But I got a few charts I can run through if we're interested. One thing we might, since we talk about interest rate, here's the key thing what's happening with interest rate. And Scott, we've seen this, and I think we've looked at this for months. Is see those bars? Every single time we look at it, it's always in the future. They're going to be cutting for a year now, and it still hasn't happened. So here's what happened this week is they were looking at 50-50 for a March cut. Now it's at 40%. and basically market's fully priced for 25 basis cut by May for the May 1st meeting. So we'll see when that happens. But I want to take in a little bit to a few charts I was playing with this morning, and this is one of the key things I spoke to you about a lot with Scott, and that is, I think the Treasury market, I think the long bonds and Treasury bonds are going to be a good place to go, and I see severe deflationary forces globally. So first, I start with a 30-year yield here, and it hasn't made a turn. You just look at 30-year yields; it's kind of bumping. This is a weekly bumping on that 50-week moving average. And by the way, my standard since I've been in the business is weeklies, because dailies make you lose your hair, and I can show you that. But so here, I just want to go through this real quick. So it looks like it's finally, if we had the first dip below the 50, the bounce above, it looks like it's ticking below 50. But let's play with this a little. Let's go to the 10-year yield. Now, I have to go 30-year because I used to trade long bonds. I used to trade zeros. I used to be in that bond pit. So let's go to the 10-year note now. 10-year note's a little more definitive. Drops to the 50-week bounces. Now it's definitively below. It looks like it's really getting hammered hard. And I can show you why in a second. So let's go to the 5-year. Now there, you get a tilt. It's already making the turn. It's well below the 50-week. It dropped below the 50-week at the basically in mid-December when Powell's pivot, and now it's holding resistance at the 50-week moving average. And the yield on the 5-year note is the lowest in 8 months this morning. Now let's go to the 2-year note, front of the curve, and I'll stop there. And then I just want to show you a few more charts. But I'm going to show you this. To me, that's the turn that's happening in Treasury. You can clearly see the turn. The thing is, the market's so aggressively priced for this ease. I don't know if it's going to, and that's what I'm worried about. That's not going to happen, I think, unless the market tells us. But to me, this is all bullish for gold, and that's what I want to show you here. Is the crocodile jaw pattern. I love showing that it's very rare, and this is a chart of 200-day moving average. So what I'm trying to do here is filter out the noise. Gold is breaking out to all-time new high. That's the 200-day moving average here. It's just heading up, and also overlaid with that is the 200-day moving average chart of commodities. It's very rare to have a crocodile jaw pattern like that where gold goes up and commodities don't fall. But there's a good reason for that. I just show a little bit here is with the biggest money pump in history that's dumping, and commodities are clearly deflationary. So I'll tilt over a little bit and show you the thing I've been watching a lot is it's that Bitcoin gold ratio. And that's what I show you in the orange chart here, and I overlay it with the S&P 500 because to me that's a key measure to watch, because like we've mentioned before, it used to lead beta, and now I just really want to see how it does its lagging beta. Again, I'm showing a weekly chart. I need to see that Bitcoin gold ratio start. I mean, it's crocodile jaws again. S&P 500 stock market's breaking out higher. I've showed this chart before. It's leaving this gap in the distance, which means when it does cover it, it might be a problem. I didn't say if because it's never left a weekly chart since 1997, since S&P mini started trading. And I want to dip over a little bit into the Bitcoin because I love that Bitcoin gold ratio. But the key thing about Bitcoin is it depends on how you measure it, but one way I like to look at it is at 16-quarter basis. I mean, it basically works on a 4-year cycle. We don't have to explain that. You overlay Bitcoin on a quarterly basis with the S&P 500, looks pretty good. And the beta is 3. Now, yes, it's very subjective, the beta. The key thing is right before futures started trading, the beta was 30-ish, and now it's 3. But it's still, we need to see some kind of oomph for Bitcoin to not go down when the stock market goes down. And we all know it goes up more when the stock market goes up. But I want to tilt over to, go ahead.
No, I was just going to say, so you're talking about deflation within the commodities that are used, right? Industrial commodities, copper, silver, et cetera.
Yeah.
So with all the stimulus that's going on in China right now, are you in the camp that's not going to matter? It's not going to increase the Chinese economy. That's going to then increase demand for oil and the rest of these commodities.
It's going to matter, but I think it's so significant, the paradigm shift that's happening there. To me, it's very much akin to the significant reversion of the Japanese economy that started in the 90s. I can dig into deals on that. I've been doing a lot of reading on it. And the Soviet Union and the lessons we learned from the book Atlas Shrugged by Ayn Rand and, autocratic leadership. And I'll show you that here. So Gareth, you started talking about the Hang Seng a couple of weeks ago. So let's just take that Hang Seng index divided by the S&P 500. That's what I show you in this orange chart. And if you go back to 1975, take the Hang Seng divided by the S&P 500. The ratio now is the same as it was in 1975. And it used to lead commodities on the way up, and now it's collapsing again, crocodile jaw. So here's the Bloomberg Commodity Index in white. It's just starting to tilt lower. Now you see that little pattern there? I don't see how it's going to go up. And what commodities always do when they go high is they go back, they have to get cheap the reset. So I still, it's got this trend line, but it's got to go down another 40% for this trend line. That's part of my reason that I think gold is going to continue to outperform. I think long bonds are going to continue to outperform. And it's just that severe recession we're seeing out of China. So I just want to reiterate this. This is the Chinese the Hang Seng Index divided by S&P 500. It's going to, you should expect a bounce. But I think what's happening is everybody, the massive money in the world, have been waiting for this Chinese stimulus, waiting for bounces to sell. So remember, they really started stimulating in 2015, and we got a little bounce. And they've been stimulating forever. It's just, to me, that's part of what's happening. The U.S. is putting the kibosh in China. Europe is putting the kibosh in China. It's way overdue. So I just want to tilt over to this chart, and I'll lay off. The key problem I have from a commodity standpoint, it's like I call it an inordinate burden of the U.S. stock market to keep going up. So this is my severe deflationary reset scenario I fear this year. It's part of the reason I think gold, long bonds, and gold will be some of the best performers. If we just get a little bump in the road in the stock market, which I showed earlier, it's going to happen at some point. Just fill in that little gap, and then we can fill the gap and go straight up. The more distance you put above it, eventually when you do fill it, it's a problem. But the key thing is, this is a chart going back to 1975 showing this is the Bloomberg Commodity Index and the S&P 500. They're used to be negatively correlated. That was the whole essence of investing in commodities. Oh, you get negative correlation, commodity equity-like returns. Now I just taken 120-month moving correlation. It's the highest ever, approximately. And you see that crocodile jaws, commodities going down, S&P 500 going up. So unless we get some kind of shock, which I don't predict, we've already had that with the, a couple wars and things. If we get this, unless that stock market can stay up, but just a little tilt lower in the stock market, that is severe deflation. And it's not just something I would say, casually. Look at the history of it. We just had the biggest money pump in history. We had the most significant invasion in 80 years in Europe, and we had the second largest economy cozied up to the country that invaded, and they are so overdue for a deflationary reset. And to me, as far as a depression kicking in, it's just getting started in China.
Crazy. All right, Scott. So tell us about the crypto markets right now. Like, what's going on in the crypto markets, or tell us really whatever you want to discuss here. But I'm curious, you got deflation on one side. How does that impact Bitcoin? Does it impact crypto at all?
I don't really think so, honestly. Mike and I are not of the same mind. I think about correlation, but I let him argue that with Dave Weisberger instead of me on a regular basis. It's easier. But I think that, Bitcoin has extreme tailwinds right now and has continued to have them since the ETF sort of trade started. It is, of course, correlated at some times, but that always depends on time frame. And for me, it's been wildly uncorrelated for the past 7 to 8 months since Larry Fink sort of started making it his stump speech. And so until that changes, I'm not going to change really my opinion that we're about to hit the halving, go into the normal 4-year cycle, and that things are going to go up. A lot of indicators showing maybe 50, 60, 70,000. I don't think that's hyperbolic at all for the end of this year. I think, we start to get creeping up to those highs at that point. And then eventually we're just talking about 100, 150 in 2025 at some point. We all look back and say, man, that was easy. And I don't want to overthink it at this point, to be quite honest. I think we've had a nice correction. There's a lot of bottom signals. Showing here, we're back at the 50 MA here on the daily, but I just don't really see listen, if we get one of these black swans, I'm going to change my view. But for as long as things continue to keep humming, I'm going to ride it until we get that black swan. That's really my take on it. Listen, you're talking about long bonds, TLT raging again. Yeah. I'm happy. I'm still in TLT from, $83, whatever it is. No complaints here. I'm just going to, if it ain't broke, don't try to fix it, is really my opinion right now.
Makes sense. So would a black swan for you be like if the stock market really collapsed, that could draw Bitcoin down or something like that?
Yeah, I think that, listen, it's easy for Bitcoin to be uncorrelated in a rising or sideways market. I think we all know that in any black swan event or major collapse, all correlations go to 1. And then you basically separate the wheat from the chaff after that and see what goes where. But listen, the last time we saw that in my mind was March 2020. Obviously at the COVID bottoms, Bitcoin bottomed 13 days before the stock market bottomed, and the world was lit on fire when the S&P doubled from the COVID lows. Bitcoin went up 17 times.
Mhm.
17 times. So if we do get that black swan, what asset class do you want to be in based on history? Listen, it's not great if you bought now and we go back down into the 20s or something on an event like that, but that's going to be the place you want to be if things rise, in my opinion. Went from under 4,000 to 69,000 while the stock market doubled.
So the one
Yeah.
thing I heard that some people were doing, this was on our program Trillions, that there was a money manager who said he had a client who really wanted it. So he took 5% of his portfolio out of large caps and put it into Bitcoin, which to me means he's now going to get about 3 times that exposure or more on the way up that he probably got in those large caps on the way up. Of course, he has the risk on the way down, but he added risk to his portfolio, in my view, via Bitcoin, a fastest horse in the race. So I think what you described, Scott, was a high beta asset. But I think we have to be careful when people say, it's like I've always heard people, oh, look at the back test, how much it helped your portfolio. Like, that is not appropriate to compare something that was a baby to now something that's a mature. So one thing you're going to get is much lower volatility. And that's been happening since futures were launched. So I think people have to
You would
adjust to
hope
that.
that's to the down. Yeah, you would hope that's to the downside as
Yes,
well,
you
right?
got to see,
So
and
you obviously, you got, to be, if I'm being intellectually honest, you got that same beta on the downside of Bitcoin to get it down below 4,000, right? Much more 3, 4, 5, 6x the stock drop. So it happens in both directions.
My only issue, main issue this year is, at this time last year, we had some awesome tailwinds to look forward to. We looked at the S&P 500 at a 25% discount from all-time highs. Well, okay, we know it's making record highs now. We looked at, we could see the ETFs at some point were going to come, and GBTC was an extreme discount. Poof, all that's gone. So my bias, like at some point you say, okay, it was a great trade. You sit in T-bills and wait for the next opportunity.
What have you guys seen in terms of the inversion of the yield curve? There's been a lot of chatter that we were almost uninverting, and then we're kind of back to that inversion deepening again.
Close.
Is that correct? Is that what you guys have seen?
Yeah, I'm trying to bring it up right now. I obviously have this chart that shows repeatedly to anyone who will listen to me that you get the yield curve uninverting or normalizing, which is blue, right? So now, yeah, we were very close, about minus 0.133, now back to minus 0.339, something like that. But you get the yield curve uninverting, then you get the Fed pivot. This is Fed funds rate in red. Then you get the stock market crash right afterwards. So anyone cheering for the pivot this time could be different for sure. But the pivot usually comes before stocks go down. So once we see this uninvert, then we'll probably know, hey, is it May? Is it June? Is it September? Whatever date that is, that's when we're going to start talking about a pivot. Then you're probably going to see stocks come down. Happens every time.
I'm glad you went there, because to me, that's the simplistic way I think we're going to look back at this year. Like last year, we knew the pendulum swing too low to the downside, and now it's so far to the other side. And things like yield curve doesn't matter anymore. The Salm rule, bottom lean unemployment doesn't matter anymore. Means, okay, thank you. It doesn't matter anymore. Where's stock market prices? Well, the U.S. is the highest ever. It's the greatest. It's more expensive. It's most expensive versus GDP. The rest of the world sales, rest of the world's equities in like decades. So maybe we just get a little pendulum swing back the other way. That's what I'm concerned about. Just that little flip. And of course, when people say, everybody says the same thing, be careful. And that is, everybody says, oh, it's an election year, equity markets are supposed to go up. I don't disagree with that, but it's when we all agree. I remember hearing this in 2006 about the U.S. housing market, and everybody was proven wrong.
2008, we know what happened in 2008, and that was an election year.
Yeah. Well, so that's the thing, but I'm glad you went to the curve, because it's still not, it's to me, it's that severe deflation I'm worried about. And all it takes is one little trigger. And it's just that, to me, the trigger is that U.S. stock market. And then I look over these little things I used to trade on. I remember making a lot of money with clients and for myself, just being in the macro, but sometimes using those little tweaky things like that little gap, and making a lot of money sometimes. Okay, here's the macro, but here's what might trigger it. All you need is for the S&P 500 to go to that level, just where you left the gap, it's 5%. And the fact that since 1997 it's never left a gap makes me think, okay, well, all these little things, that might be one of those things. You're always looking for triggers, right? I'm sure you are as a trader. That's a potential trigger. Just keep it on the radar, and just question of, how long it's going to make me lose my hair.
So I'm looking at the dollar chart right now, the Dixie, right? And so, if you zoom out, we've been in this channel, just hitting the high end, hitting the low end, back to the high end. Are you guys in the camp that the dollar is going to head up? Like, is there going to be geopolitical risk where it just pushes the dollar up, or we think that the dollar is kind of beginning to curl over again and heading lower?
Can I give you a little bent on that, and then Scott, you go on it. Thing I've really enjoyed pointing out to classic bottom up FX type people is what's happening in the hottest technology on the planet, and that's been cryptos. I mean, completely went to crypto dollars, stable coins as the base layer. There's no other anything even close as far as other stable coins. So I like to point that out in terms of the dollar. So people get bearish the dollar. I'm like, do you realize, like, if you measure the dollar against a basket of currencies, there's nothing even close. So I'm bearish the dollar versus gold, and maybe Swissy, but versus any other currency on the planet, good luck. And then you have the key quote, like I enjoy from Jamie Dimon, and some of these other countries that have a higher rating than the U.S. are all under the umbrella of U.S. military protection. It's just unstoppable, the strength of the U.S. right now, completely compared to the second largest economy, which is potentially going into a depression. And then you have the third largest economy, Japan and Germany. Both of them have zero rates and both under the protection of the U.S. It's just laughable to think the dollar can really drop that much. And I'll end with this. In the U.S. dollar, you get a 5% T-bill guaranteed. Every day you hunk down $100 with the U.S. Treasury, and a year from now, you're going to get $105. Can you get that in China and Japan or Germany? That's the top 4 countries of the world. Maybe India, because that's the 5th largest country.
Mike, my question for you is, can you have that U.S. strength that you're talking about, but not necessarily have the dollar strength to go with it?
Well, so that's the key thing. You typically, here's one thing I'm really concerned about, and the dollar. And see, this chart is one thing that our equity strategist has really been honed on to me is if you look at the trade-weighted broad dollar, not just the Dixie. Dixie's against Europe. Since 2011, it's almost tick for tick with the U.S. stock market outperforming the MSCI ex-U.S. Stock index. So U.S. stock market outperforming the world. So the biggest tilt risk, I think, the double negative, I think, for commodities and risk assets is if the U.S. stock market tilts lower, the dollar tilts lower. It almost implies they have to be together in that phase. So at some point, you cannot go. Trees don't grow to the sky. They have to at some point stop. That's the key thing I'm worried about. But right now, if you look at the Dow, let's put it this way: if the U.S. cuts rates 100 basis points this year, and no other country in the world cuts rates, the U.S. is still double the 2-year note rate in China. Many X's of rate in Japan, double the rate in Germany, the 2-year note rate. It's unstoppable. The thing is obviously the deficit, but who's better? I mean, what single country with anything near the depth of like the U.S. Treasury market? Yes, we have deficit problems, and the debt to GDP ratio, I hear China is almost 3 times as much. Japan obviously is much more. Germany might be more fiscal, but again, there's another country on their umbrella of U.S. military protection.
So one thing that, and this just popped into my mind, switching mode a little bit, Scott, is I remember reading just a few days ago that Tether reported something like a $2.85 billion profit. First of all, and call me an amateur when it comes to crypto, I didn't even know that they could report a profit. Like, I didn't know that they're basically like a company. And so I guess my question to you, and I don't know if you know this, but like, how do they generate this? How do they generate profits? And then, being a company that reports profits, isn't that kind of like a stock or like
they made more money than Goldman Sachs, I think.
Yeah.
Of late. This is a Solana chart. We don't need to bring that up, but yeah, first of all, so Tether is probably the biggest beneficiary of those high rates that Mike likes to talk about, right? Because for them to mint more treasure, that means that one of their clients who has direct access to tether.io or whatever it is has to go deposit dollars, which are then minted as stable coins. They take those deposited dollars, they put them into U.S. treasuries and literally just make an absolute killing billions and billions and billions of dollars every single quarter. It's a private company, so it's not really like a stock. The actual asset is just a minted version of the dollar that's deposited into their bank account. So it's a private company, right? So they're making that money. They're taking those profits, doing that which they want with them. A big part of that is buying Bitcoin. They own billions of dollars now in Bitcoin. That is not to back their stable coins. They're buying that with their own corporate profits for their treasury, much like a MicroStrategy on the balance sheet. But yeah, it's an insanely profitable business when yields are high, because they can do exactly what Mike's talking about. It's extremely bullish for the dollar, actually. They just park that money in treasuries, generally shorter term treasuries for them and extremely liquid because they have to be prepared for redemptions. They've had $7 billion in redemptions in a matter of weeks before with some of these collapses and have been able to do it without a sweat. I think in the past, maybe Tether wasn't fully backed. Now you literally have the CEO of Cantor Fitzgerald going on his roadshow, much like a Larry Fink, saying, we're holding their assets, guys. They're fully backed. This is an incredible business.
Wow. I got to piggyback on that one because Tether is one of the key. I was very bearish in 2017, all cryptos, and I got a lot of pushback for it. I really enjoyed it. People don't seem to realize that being independent, it's when someone really disagrees with you, you're almost always right. It's when they all agree with you, you're almost always wrong. But it was being in Hong Kong and talking to Chinese nationals and non-nationals and everybody's and I remember over refreshments and I should say, a few drinks, being told by some Chinese national, Mike, don't misunderstand Tether. This is transmogrifying our lives. We can get the whole world can get exposure to the dollar through their phones. And at the time it was $2 billion. So I really got it back then. I'm like, okay, this technology is revolutionary. I don't remember when, it was right around Bitcoin when it was around 5,000. I finally got bullish. But Tether has been transformed. So I just pulled up a little article on Bloomberg lately, and it's almost $100 billion. Back then it was $2 billion. And I just look at it, this is an unstoppable force. Yes, they might be dicey, but it's just access to that dollar. And the key thing, as Scott mentioned, is the quote I heard is they might go public, but on a per employee basis, they're the most profitable company, probably the most profitable company in the world, and one of the top holders of treasuries ranked versus countries. And when you're the U.S., don't mess it up, just regulate it. And I think that's where it's going.
They're helping the hyper-dollarization of the world, right? Because in these countries where people can't get dollars on the black market, they can't find cash, they go and buy Tether, and that increases the market cap and increases the proliferation of the dollar. And every one of those Tether stablecoins is backed by an actual dollar that's being put into a U.S. Treasury. It's unbelievable business.
And look at it on a global basis. We see what's happening in China. I mean, it's the second largest country. There's a massive amount of wealth creation. Why didn't all this crypto, the organic crypto market, not controlled by any government, go for the yuan or the yen or the euro? Or even the Swissy or the pound? It went for the buck. And that's just such a statement
100%.
for how people say the U.S. Influence is declining. I think that from a standpoint of every single central bank in the world has to watch every word that Mr. Powell says. It's the opposite. And Tether to me is a good example of, you want another currency? Go for it. Good luck with that one. And
Mike, they've tried. So we have euro stable coins from all of these issuers, including Tether, gold backed stable coins from all of them. Everybody, we've never seen any popularity of any of the other stable coins outside dollar. Yep.
Amazing. So we just have a couple minutes left, and I just want to kind of cover some of the big events coming up in the next day or so. So the first one, obviously, after hours today, Apple reports earnings. Apple's getting a big bounce. Now, it's kind of, you can see it's fallen off a cliff recently, but today getting a big bounce with the rest of the market. The dollar's falling, yields are falling. That's a recipe for upside in equity prices, and certainly we are seeing it. So it'd be interesting to see Apple after hours today. You have Meta after hours today, as well as Amazon. So the multiple $trillion companies. I don't know what those all equal, something like $7 trillion reporting after hours today. But that'll be big. And then the last one is the economic report tomorrow, the non-farm payrolls. I think I saw that 187,000 is the expected number. But remember, private sector ADP did come in weak on Wednesday, and jobless claims are starting to creep up. So it'll be interesting to see, like Scott said, I mean, do you even believe them anyways? But let's be honest.
It's going to come in at 175, and then they're going to revise it to 275 when nobody's looking. Perfect.
True. But having said that, the markets will react based on the number, at least initially. So I think that's important. But again, 187 is the number there. And then I'll just kick it back to you guys. What are your final thoughts? I mean, whether it's crypto or economic or anything, give us some final words.
Go ahead, Mike.
Final words is, I think what you said is more significant. The number's less important. The revisions are usually more important. It's just a trigger for people to do sometimes what they wanted to anyhow. It's very rare you get a major change in sentiment. You need the whole shift over. And the key point I like to make is, for this year alone, the major risk is, remember, it's only we've just went through January. We've had 3% in the S&P 500. That's great. Just a couple more months of that, and we've already had a normal annual year. How long is that going to last? I look at the biggest risk is the pendulum swinging a little bit back from last year, which favors probably gold, treasury bonds, and I got to see how the world's most significant leading indicator, Bitcoin, either can lead. If it can lead that, how it will lead this year. I want to see the arguments I have with Dave, see if it can show other than just being a very highly speculative, high beta measure of the S&P 500, particularly now that it's in the ETF space and it's all, most of the ARB is gone.
Scott, what about you, buddy?
I'm just glad we've grown up enough to be considered the world's leading indicator. 24/7. I would have never thought I would hear those words about Bitcoin, which I think, depending on your view, half glass empty, half glass full, means we've made it, baby, no matter what comes next.
There you go.
Nice. And last thing I'll leave you guys with is last night I was on Costco.com and I saw bars of gold being offered, and believe it or not, it was only about $30, $40 over spot. And then I got one of those, like one of the executive memberships that gives me 2% cash back. So I picked up my allotted. They only allow 2 ounces of gold, 2 bars of gold, but I got it for just under spot. And I'm proud of that. Be able to grab it and hodl that gold for a few years anyway.
How long until you can buy 2 more? Is it just
you know what? I don't know. Maybe next year I'll have to. Maybe I'll even try going back today and see if they let me.
So let's see how this year works out. But I'm still sticking with my call. I think it's going to be a year where gold's going to outperform Bitcoin. Obviously, that means more of a risk off year.
I like it. I go with it too. All right, guys, make sure to follow these gentlemen. They are awesome, as you guys can see. And we'll be back next Thursday with another Market Mavericks at 3 p.m. Eastern time. You guys have a great one. Take care.
Cheers.